Okay, thanks for joining my webinar today. My name is Dennis Kalishkin. I'm the co-founder of Ask VC and the co-founder of Space Ambition. I'm also a principal at New York Venture Capital I2B Global Ventures, and our fund specifically invested in quite a few deep tech companies. So I have some visibility. I kind of seen quite a few deals, understand how it works. And I'm an aerospace engineer myself, so I'm really passionate about technologies, and I became actually a venture capitalist because I wanted to help people to build businesses which use technologies and then earn money on the technologies and then refuel those earned money into applied and fundamental researches. So here I am. And why I do such webinars as today, I really want both to investors and founders to understand how those investment decisions are made. Especially, it's very instrumental for generalist VCs, family offices on one hand, because they don't have experience of investing in deep tech, or and also important to founders who are running those deep tech businesses, how their investors or future investors are making decisions. So typically, such sessions are eye-opening. And you we will be recording this call, and this webinar will be published on YouTube, and I also will also share with you the video recording. So please ask questions in the Q&A session during the webinar or at the very end. Yeah, and if you ask like questions by voice, be prepared that it would be published on YouTube, so that like so just if you make any comments, yeah, by that you subscribe to grant us permission to to host it publicly. Okay, so what will happen today? Today will take a really public case published by Bessemer Venture Partners of the company Velo3D and how they invested in this company. And I will walk you through the text. I wouldn't be showing you presentations, but instead I will walk you through the text. I will show you some additional information. And after our session today, you can read this investment memorandum yourself and better understand like what's written in it. This is already the fourth lecture of this type. So we previously looked into Rocket Lab investments and also looked into VIX and LinkedIn investments by Bessemer. So you could also watch previous video recordings as well. And I hope that it will help you to understand how we VCs think. And also, I also want to do two announcements. First, I'm planning to do a coaching for those of you who would like to understand how investors are making their decisions. So what we will do, we will take a case like that. I will give you a couple of videos to watch. Then you will be reading the case, and then we will be discussing it in the group. And my motivation is to transfer knowledge of how it was, how such investments decision I done, coaching you on real cases. So if you want to join this session, I will be doing it in August. I please send me an email at askvc.org, dcaskvc.org. So just send me a quick email saying that, oh, I want to join to your coaching on how those investment decisions are made. And to tell me why in the email, just briefly write to me like who you are and why you want to join, why you need this knowledge, because it's a very I would say like time consuming for me. So I want to understand and yeah, I like educate people, but I want to understand like why you need those knowledge. And I want to take the people who are motivated to acquire those knowledge, not like the tourists which, watch one webinar and then quit. So, yeah, but if you want to understand how investment decisions are made, feel free to reach out to me, yeah, I'd be happy to work with you during 2 weeks in August. Then also we do a deep tech advisory, both for investors and for founders who want to either to raise funding or to understand how VCs are looking at their decisions, or as VCs to understand better understand either specific opportunity or the field in general. And we typically look at all types of deep tech solutions except for medical and pharma. Because we are physicists, we are engineers, we are not biologists or don't have experience in medicine. So yeah, and we have like it's a paid service, but you can reach out to me, and yeah, we will look into your case and then decide like how we can help you. Yeah, and also an important disclosure: this lecture is for information purpose only. So because Velo3D is a publicly traded company, you can purchase their shares. But I'm not doing this webinar to inspire you to invest in the public shares, because we will be looking at the use case, which is which happened a decade ago, and all the information is based on the public information which Bessemer Venture Partners shared and kind of my understanding. So we will be looking at the case as of the date of May 2015. And this webinar is just for information purpose only, just as a case, just illustration. If you for some reason want to invest in something like that, yeah, I strongly encourage you to get a professional advice from relevant people. Okay, so without further ado, let me share my screen. Okay. So, first of all, if you want to read this case afterwards, you just go to the Bessemer BVP memos and Velo3D. And by the way, if you go to to this link, you can find about 60, 70 companies which were publicly shared by Bessemer. And these are the success cases, how they invested at startups at various stages, and you can go and pick any of those companies and to read it. But I hope that the approach, how you should read those documents, will help you to read any of those cases. Yeah, and we also have this prerecorded and text article for Rocket Lab. I will be also sharing it with you as well. You will get it via Luma. Okay, so this is an investment memo. It looks like that. And they come in various shapes, but typically it's a document, PDF document. In this case, it's more like an email, but it could be also in the form of presentation. And this is an internal document which founders typically don't see. So this is our vision as a fund, like VVCs prepares those documents and show our vision on the deal. And there are some chapters here which founders typically don't think of. For example, at the very end we have this risk session, and founders. I don't meet many founders who are at least discuss those risks with investors. And there is also another section of return on investments. So I will quickly guide you a little bit later how they assessed, how they did this scenario planning. Okay. But when it comes to investments, especially we will be looking at the Series A investment, and especially when it comes to the deep tech investment specifically, it's very important to look into the team first. So this is why we will focus our attention at the first of all at the team, and then we will look at the other parts of this equation. So the CEO of the company is Benny Baller, and and let's first look at his background. So, and like before we look at his background, there is also very interesting fact. So, how did this deal land on Bessemer Venture Partner? And here in the text, you can read it. So, uh, this deal was introduced by CEO Peter Beck, the CEO of Rocket Lab. And it's also interesting in terms of the timing, because first of all, these two gentlemen, David Kowan and Sunil Nagaraj, were doing closed in October of 2014 another deal. So these two gentlemen invested in Rocket Lab, and they had good relationships with Peter Beck, and this is why Peter Beck persuaded Velo3D to take money from Bessemer. But initially, the company was backed a year ago. Was backed by a number of very respectable people like Lightspeed and Khosla Ventures and Foundation 8. And by the way, Rocket Lab Investments was a mutual investment with Khosla Ventures. And specifically, if we look at the Crunchbase, so if we look at Crunchbase financials, and if we look at the first deal of Velo3D, it's also interesting. So if we look at their Series A, this deal which we're exploring, it was closed by Khosla Ventures, and it was closed by this gentleman, Sven Strømband, which happens to be the investors behind Rocket Lab Investment. So you see how those people were connected before closing this deal. And yeah, if you look at the deals which are really closed, you can find more patterns like that. Anyway, so after we talked about the background behind the deal and how those gentlemen got to know each other, so let's look at the founder. And by the way, this memo was written before CEO presented on the investment committee. So particularly, probably they were in a rush with this deal, and they sent this memo before. But like, okay, it's always the case that you send the investment memorandum before the actual investment committee happening. But yeah, the other investment committee member, they didn't meet Benny Baller, and the founder will be pitching to the team like probably the next day or two. Okay, so now let's look at the team first. So of course, so first of all, the team was done because of the CEO, Benny Baller. This gentleman has a pretty good experience. First of all, the two co-founders are originally from Israel, and this is really important because the Israeli startup ecosystem is built around the special units of the defense force, Israeli Defense Force. Specifically, in case of Benny Baller, he is the graduate of this unit. I googled it. It's not very famous because of the startups backed. More often, the startups backed in the Israeli in the Israel are coming from unit 0 to like 8 to 00. but this unit is famous for its technology, like the high quality tech people that they graduate. But I didn't find any. Um, Many traces of very well founded companies coming out of this unit. But all in all, the like if in the United States, education or graduation or like PayPal mafia and stuff play the role of this network which facilitates the deals. In Israel, oftentimes this the like not oftentimes but always is done around the serving an army, and there are even funds which are specifically focused on some and backend startups from some units. But like this is just a quick context specifically related to Israel. But all in all, he had a very good background because he worked. So if you look at his LinkedIn profile, so he had a pretty cool track records. So give me a second. So before founding this company, he has a big track records in hardware. So he started. So after serving in army for 10 years, he joined and applied materials, and he was a program manager and director there. Worked for like several years. Then he was VP of engineering in this company Solyndra, and back then Solyndra was also a pretty well funded company. So give me a second. Um, Solyndra. Yeah, so back then in 2015, so far as I remember, so yeah, no, sorry, when he was working in between 2006 and 2007, so he was working in a company when they raised their Series B of 79 million. So he worked in big companies. He worked in on engineering positions. He worked in well funded startups. He worked in this big deep tech company on the management position in the United States. Then he was for 2 years. He was an investor in Khosla Ventures. So that's also also gave him network and credibility. And I believe could probably even been incubated out of Khosla Ventures, and Khosla became their first investors. That's natural. And then after that, he was on the boards of quite a few hardware companies. So what I'm saying is that first of all, he had very good connections in the VC world, and you know. People from Khosla Ventures at least knew him personally pretty well, and they trusted him. And when you have relationships like that, you can get money more easily. And the other gentleman is also very experienced from on the tech side, and more importantly is that they worked together in the same companies, like in Applied Materials, in Solyndra, and in First Solar. So I'm pretty sure that in all the three companies, or subset of those companies, they even probably work together on some projects. So what I'm saying is that despite given first of all, both of them have very good background, which we see typically like, but they also worked together in a number of companies, so they have the history why previous history of working together. And Benny even worked in Khosla Ventures as an investor, so he both understood the VC play and also had quite a kind of a network experience and very deep trust at least from their lead investor of the previous round. Okay, and also he also who had about 120 patents. So he has also a pretty good track record on the engineering side. And there is also another interesting fact is that they had this gentleman, which was VP of products in the leading 3D printing company, Stratasys. So on the board of Velo3D, of course, it's not a full-time person, but it also brings a little bit, more comfort to investors when they make a decision to invest in such companies. Okay. Now getting back to the deal. So first, like we looked at the founders, we looked at their previous backgrounds and how they work together. So and the background with Khosla Ventures, why there was like there was trust. Then we looked at how the company was introduced, and now we will look in the deal into the deal. So. Before this deal, which is happening in May 2015, previously the company raised $4 million, like in convertible note, at the 12 million pre-money, and it was coming. It was a year ago, and it was coming from Khosla Ventures and Lightspeed, pretty respectable people. And now they were going to do a second round, and initially they wanted to raise money from existing investors, but Peter Beck persuaded them to take the new round from Bessemer Venture Partners. So, as a general rule of thumb, it's better when your round is at every next round is led by a new investor, so fresh money are coming in. While when people do that internal round, it's not necessarily be like bad, but typically, if you could persuade to invest in your company a new investor, it's even better. So for them, and the other thing, like why Peter persuaded them to do this deal is probably he was comfortable with doing business with Bessemer. Yeah. So and the next round, they were discussing a deal of. Leading the round for 8 million out of 15 million. So they have 7 million coming from other investors, including existing investors, and 8 million will be invested by Bessemer. And the post-money valuation will be 40. So they kind of get in about like 30% of the company or something like that. And they will get the standard option pool of 10%. And then they add that formation, the existing investors will put 5 million, and Autodesk, a strategic investor, especially this is good for 3D printing industry, is coming with $2 million. So we have pretty good setup for the round. Now let's look into the market size and trends. And here I want to add 5 cents on my personal experience. I've been since 2014. I've been in the venture capital market, and specifically back then I was focused on investing in some industrial technologies. And I remember vividly the hype and how it vanished around 3D printing. And I looked back then. I looked into quite a number of companies around 3D printing, and in 2014, it was still a strong belief that 3D printers will be in every house, but it didn't play out. And this is really important understanding this narrative because it shows why this specific investment was good. Because in 2014 and 2015, this narrative of, oh, we have a 3D printer in every house was fading away. So investors has been, gradually becoming disillusioned from this thing, while Velo3D was pitching an other thing. So let's go to B2B. So we will be providing a 3D printing solution for businesses and for a specific niche, and they have some unique thing about their technology. So that's narrative was it was pretty fresh and like was down to the ground, and there were some other trends which were showing why it's cool, and I will show it in a bit. So all in all, 3D printing market size was $4 billion. And typically, investors, when they are making an investment decision, they want to invest in a company which would be doing operating on a market over $1 billion. But specifically, Velo3D was focused on metal 3D printing, and it was only 15% of the market, or $350 million, which was 3D printing, which accounted for the metal 3D printing. And as you see, the majority of the market was plastic 3D printing, and in most of the cases for prototyping. And the thesis of investing in Velo3D was that because of their technology, they could, and if you look at this graph, you also see that metal 3D printing was also in most of the cases for prototyping, while some unique parameters of their technology could enable displacing those CNC machines with metal 3D printed goods, and that was the thesis behind this investment. So looking at the market, so we see that the overall 3D printing market is growing. The metal 3D printing is still a small niche, but what recently happened, and we see it on another graph, just recently, just in 2012 and 2013 and 14, like the metal 3D printing market, the number of units, the number of 3D printing machines sold, and it's measured in hundreds, for the top four competitors grew intensely over the last couple of years. So it grew like 40 to 60% year over year. And yes, the existing market was only 350 million, but like if it's doubling, if it's growing 60% annually, so it will cross in a couple of years, it will cross $1 billion, and that was the thesis. So that we're now at the point where all in all 3D metal printing market is growing, and Velo3D is developing even a better 3D printer, so they can grasp a pretty good share of acquire a very good share of this growing market. Now, another important parameter which we will need to pay attention is that an average 3D printer, metal 3D printer, cost $700,000 per unit, and the majority, and that there are quite a few various applications for industrial manufacturing, in the aerospace, academic, automotive, and other sectors. But as of the date of this deal, there were only four European companies. We'll talk about those companies in a bit, which were producing those printers, and they were producing them and selling like about 10, 20, 40, up to 100 something units annually. So it's anyway, it's and all of those companies, they were pretty established and have a pretty big industry. And yeah, it was the thesis, okay, we invest in the US company, which could be like grasping, acquiring a pretty big share. And they as you see, they say that because of specifics of the technology, they could unleash and grasp a share of $500 billion market, which is now which is now a CNC machine market. So not the CNC machine market, but tools which are produced by CNC machines. So that was the thesis why specifically they wanted to invest in this deal. So then they tell the story like how this 3D metal printing works, but in like if explain it into words, so they use this powder and they melt it with specific lasers, and then they produce various shapes. But the problem with all the other existing other existing 3D printing companies, 3D printers, they needed some, to support those. If you have a very specific form, so before printing it, you need like, kind of build some skeleton. Otherwise, if you don't use it, the printed thing will collapse. So, and that was very different from what Velo3D did, and because of these specifics of technology, they could unleash, they could print very unique, very unusual forms, which could be used for very specific things. So they will even they even have somewhere yeah, I'll even show you what they could print. Yeah, then they describe the product and they say yeah, like it comes in various forms. It's very rigid. It could be done not only for prototyping, but for producing real tools which are used in real in real finished goods production. Yeah, then they are talking about the benefits, but more or less, yeah, it's all about the speed, it's all about the rigidity, it's all about the uniqueness of the forms, it's all about building the real tools like this tool, which was used for SpaceX Falcon 9. Uh, and yeah, or some the belt buckles like that, which are very lightweight compared to to what we use now. Yeah. Then a very interesting, small but very interesting part is about like intellectual property, because uh, back then it was already a big risk of making a copy of your whatever you hardware you produce by Chinese, and their approach was first like don't do patents for all of the solutions, but do only patenting around some essential things, and other they use this regress, so the patented technology was not only could be they could not only sue the original manufacturer of the 3D printing machines, but if they see that some patent infringement in the finished goods, they could sue the companies who were using those machines. So that was their IP protection mechanism, which they kind of could protect them from the Chinese competitors, because they were suing not the manufacturers of the 3D printers, but the companies which are using it for the production. Now there is another chapter talking about the funding. So they plan to expand their team of 12 engineers to 34 with this 15 million. But what's more importantly is to look at the graph. So as you see, is in May 2015, as of the date of the deal, they're still in the proof of the concept phase. They didn't deliver the demo of product. They didn't start the designing of the film machine. They didn't get commercial terms, signed contracts, but instead they collected, and they are in the middle of the process of collecting tech specifications from potential clients. So kind of many technological risks are not solved yet. And when you read it, when you read it, and yeah, probably you can read it below, but somewhere in the text you can find that what they essentially did for these 12 months and this $4 million investment before this coming round, they demonstrated that they could print several very unique forms. So they kind of proved that they can that they can do printers which do some very specific forms. So the main thesis of the company investment, but they didn't build working prototype which could build like any or many forms. So they just proved the main technological problem, kind of proved, but still they still had this huge engineering risk they were taking. And the other thing which is important is that based on bill of materials, they expect their machines, their printers cost like $350,000, while as you probably remember, the others are charging $700, $100,000 for per unit. So what they're saying is that there is a room of for cost optimization and pretty high margins. And yeah, now that you can also see like the plans on the annual revenue. Yeah. Now let's look into the competition. So again, as I said, the majority of players were very limited in the shapes and forms of what they could print it with their 3D printers, and some of them require vacuum and high temperatures and stuff. But those companies, those here are a few companies, and as you see, the majority of them, like several hundred employees companies. This is like 3D Systems, the biggest of them. This is also the biggest of them, but uh, those big companies, they only very small. So it's like this metal 3D printing was a tiny fraction of their existing business, and a very small portion of the team, like 2 to 5% were working on those projects. Yeah, yeah, and we looked into the team already. So what I'm saying is that they were competing against some established companies, like mid-sized companies, doing some millions of dollars, tens of millions of dollars in revenue, mostly in Europe. And those companies were a bit ahead in terms of monetizing their 3D metal 3D printers, but they also had those companies had drawbacks, and for those companies which are big, it was not the main product they were selling, so there was like kind of expectation that you could overcompete those players. And now let's look into the risk section. So the first risk they were looking at was the technology risk. Again, as I said, yeah, um, they have printed some pretty unique forms, but still they didn't have a working metal 3D printer. So yeah, it could be prone to delays, or technical specification could be not as good as they pitched during the investment committee. So technological risk was still pretty while the technology was maturing, the technological risk of and the price of the printer, etc. There was, still a big risk associated with this thing, which could lead to delays, etc. The other risk they were considering is that existing market, yet it was growing pretty fast, was still small. And their thesis was, okay, if they build a really cool machine, they could they could acquire part of the market of the CNC machines, and it will, vastly expand the market size for their solution. But still, it was, a risk which was not proven. But to tell you, like, to be honest, this is the typical risk we as VCs take when we make especially deep tech investments. Yeah, and the competition, yeah, they had roughly 10 competitors, but the real competitor was Arcam. And what's interesting, and this is why I am saying that they are a little bit in a rush with this deal, is that they say, okay, we looked into all the 10 competitors, we identify only Arcam, but we still need to dig deeper to better understand how they are different, what's the IP protection and stuff. So they were treating competitor risk seriously, but there was only one company which they really considered to be a direct competitor. And yeah, the last chapter, and the founders typically don't look into this one, is the returns. And you see, like, how Bessemer do this, they typically, show 5, 6 scenarios showing the exit value. So what they show, the exit value like 0 million, 15 million, 100 million, 500 million, 2 billion. Then they also show like when this scenario will materialize, like in 2 years. You see that those bad scenarios, they typically happen in 2 years just because the startup runs out of money, can't raise more funding, so you either sell it as an IP or you sell it or write it off and calculate their MRR, while the medium scenarios, as you see, like happen a year or 2 year more, and they typically expect that the company raises more funding, so that their returns will be higher, and you also see the probability of the scenarios. So as you see, this optimistic scenario of $2 billion exit price was just 3%, while those four scenarios, have bigger percentage. And I don't know how exactly they do this calculation, but I'm pretty sure that inside of Bessemer they have some uh, formal formula, doing some weighted scenario analysis, and probably this formula is written probably some person from Stanford, and they use the historical statistics of failure and materialized scenarios about historical statistics of the overall market, of the scenarios of companies in their portfolio, in the Bessemer portfolio, and it's just like the methodology which is written like which is standard methodology which is approved inside Bessemer, which they use from deal to deal. But essentially, what they do, like they do like several scenarios, and then they calculate the weighted average MRR. Yeah, and that's pretty it. That's pretty it. Okay, so now you can draw questions. I walked you through the whole case, so please drop your questions, and I will be happy to answer to them. Okay, if you don't have any questions, we can wrap it up for today. I hope that, and essentially the way as we looked at the deal, you can look at many deep tech deals in various geographies or in various niches. So like the approach will be more or less the same. And again, as I said, if you want to learn more and to get coaching, please send me an email. Paul is asking, how is it different when the company is per revenue? Uh, you can actually, so most of the many deep tech companies are pre-revenue, and so far as I remember, this company was specifically pre-revenue. If you look at the case of Rocket Lab, the company was technologically more advanced, but it was still pre-revenue, but it had a huge pipeline of the clients. And if you look at Dropcam case, the deal is even earlier than that. So essentially, it's just if you read the Dropcam case, like here, for example, you go and you see the Dropcam case. It's also a deep tech. It's more like a hardware, and they are investing 200K, and like it's very very like small investment memorandum. So essentially, they say we like the founders. There are some risks, but like let's play in this casino. So that's how I done when the company is less advanced in terms of revenue. And the more advanced company, the bigger the rounds, the more you account for the pipeline and stuff. You give me a second. How do you get the copy of this investment memorandum? It's publicly available. I will share it with you together with video recording, and it will be also in the description of the video. But you can go to Bessemer Venture Partners or ask like LLM, whatever you uses, the investment panel of Bessemer for Velo3D, and you will find it. How Bessemer arrived on the pre-money valuation. Uh, oh, to be honest, it's more like an art than a strict formula. And the valuation is essentially the price at which both parties want to make the deal. So there are some. When we talk about valuations, you could go to, for example, to Google and ask KPMG, KPMG Venture Pulse, and Carta. So there are quite a few providers which do those averages, and you can look like what is the average, what is the maximum, minimum valuation, and the corridor for those valuation shares granted. So you have like those graphs like that. So this is a pretty big report. You could read it. It's quarterly updated, or Carta does such reports. But essentially, what we as investors do, like we look, okay, at this stage from the pipeline, which we see, upper and lower variations are in this range. And then like you decide like what's the appetite for your deal, for this deal, and how competitive is the deal. And you kind of find the value, find the price tag at which both parties are open to close the deal. So that's how it's done in real life, not strict formulas, very sophisticated formulas. But to be honest, all types of assets, valuation for all types of assets is done that way. If you want to buy a used car, you essentially do the same. Like the upper and lower limit range for the prices of used cars, and you just go and look at some company cars, and you decide, oh, I like this better than that, and there are some how it looks like, how is it like from technical perspective, and exactly the same you do when you purchase a house. What were the dynamics with other possible leads? So from what we know from this investment memorandum, the other lead investors were investors from existing investors who are leading the round. so we don't know much about the terms. But in some other deals, you could also look into like what was the situation with the lead investors in those deals. For example, if you read the case of Twitch, so for the Twitch case, they were betting. Bessemer was betting against another fund with not that experienced and strong brand, and the valuation. Bessemer was giving the valuation twice lower than the other fund, and yet, they were into the deal just because the brand of Bessemer and some other parameters were better for the team. How do you invest in companies where landscape changing very quickly? I know some I see another companies who, even after getting the initial investments, are still pivoting their main focus. So I wouldn't be talking about how like I2BF specifically does such investments, but in general, VCs, yeah, we need to take into account both the stage and the state of the market. For example, if you're doing a AI solution, like the landscape changes pretty often. But what we try to do as investors when we look at something, we try to answer, okay, is it like just a narrative, or are there some first principles why it will survive, like changes, and it will be more sustainable in the future. But of course, at the very early stage, like if you look at the case of Wix or the case of Dropcam, you just look at the good team, you kind of see they're kind of doing something right. We're making small investments at low valuation, so let's put money and see how it goes. So the go-to-market, the product, and all the other parameters, and how we need to take those risks of the product being changed. It also depends on the stage on one hand, and on the other hand, you can do the deal, invest more money and take more risks of very of the products which is like less developed, in case you have a more experienced team. So in the case of investing in Velo3D, they have very experienced team, which had good track record. One of the founders had good track records with their lead investor of the previous round. So and as you see, the solution was like at the very early stage of development, and they were raising $15 million fund. While if you look at the case of Rocket Lab, the round was about $18 million, but the company was far more advanced, both in terms of developing the technology, having flight heritage, and the pipeline. But Peter Beck was an entrepreneur from New Zealand, so he had to prove to investors more than in case of this Velo3D. How to investments in companies is similar in similar verticals get handled? Would an investor actively avoid investing into companies that might be competitors? Yeah, as a general rule of thumb, investors try to avoid investing in direct competitors because you have a conflict of interest. The exception would be like very big funds and very big, accelerators like Y Combinator, for example, which can invest in direct competitors. But as it's generally, we try to avoid investing in direct competitors for potential conflict of interest. And if you lead negotiation with investors, make sure that they didn't invest in your direct competitor. And all in all, how we as investors look into like existing competitors which could be well funded. For example, if your direct competitor raised $20 million just 6 months ago, we treat it more like a signal. While if your competitor raised, like for the last 5 years, raised $500 million, we are asking ourselves, like, are not you late for the party? So, and if not, like, you need to prove that, yeah, those well-funded companies did something, something wrong, and you have a unique approach why you can bet them. But yeah, it happens sometimes. But generally, if it's like the last case I've described, typically investors prefer to invest in like established founders. So, for example, if Elon Musk comes over and wants to build something and directly compete with well-funded companies, then investors will say, okay, yeah, we know this guy, he can do that, even given that his competitors have previously raised hundreds of millions of dollars. While if you are newbie to the market and you compete against like a well-funded company, yeah, the investors will be more cautious. From my perspective, VCs usually invest in Series A startups because of their strong traction and recent revenue growth. However, lots of startups actually just got stuck in this stage. I'm curious if there are any other signals point that can prove their strong potential to move to next fundraising. Also curious about, do you have any method or thesis to balance the risks and potential? Oh, the latest about balancing risks and potential, it's more like, at least now, it's more like less like a science and more like an art. So you at some point you just say, okay, I'll take this risk. So it's more like it's more like an art, as I said. But when we talk about deep tech investments, oftentimes, like at Series A and sometimes even at Series B, you have this technological traction while you don't have the revenue traction, because in many deep tech companies, revenue traction comes like years later after you raise like 20 millions of dollars, for example. And those investors which are focused on investing in deep tech, they got used to it. And for example, in Bessemer, this in Bessemer Venture Partners, this deal was done by the two gentlemen, which were specifically focused on deep tech investments. So the partner David Cowan, this guy, before making this deal, he has been partner in Bessemer. He has been a partner who invested for 20 years in various deep tech companies. So he got used to the risks, etc. So yeah, so for deep tech investors, it's better, like it's easier to make decisions and not pay attention to not paying attention to revenue traction, or taking some risks. But yeah, again, as I said, like deep tech investments at early stages, what's important first is the team, feasibility of the technology, and you pay a lot of attention how far how advanced is the company in terms of building a prototype, testing it, like producing a commercial prototype, signing MOUs, or having flight heritage, etc. So the first couple of years, those parameters pay more play the role of traction, which investors pay attention to. Okay. Any other questions? Okay. Okay. So I hope that it was useful to you, and I would wrap it up for today. You will get this video. Yeah, you watch it, and again, if you want to like to learn more how such investment decisions are made, or even look at your case as a like either as an investor or as a startup, yeah, please shoot me an email, and we will discuss uh, how I can help you out with this. Okay, and yeah, do deep tech deals, build deep tech startups, be successful, and move the humanity forward. Thanks for joining me today, and thanks for for passion to deep tech. I hope that together with you guys, we will build a better future for our kids and for humanity. And yeah, and we'll go beyond this narrative of investing purely in AI and purely in SaaS and purely in marketplaces, because we need to solve hard problems, not easy problems, right? Okay, thanks everybody, and yeah, see you next time. Have a great day.